then look at the data, and that's what we've done for our viewers, that for the first time in this century, Nifty is on course to go down for 4 months on the trot now. Now, to give you a backdrop here, the problem is with US banks. The problem is with European banks. There's no problem with Indian banks, but Indian banks are underperforming. Amazon, Meta, you got Google and stroke Alphabet who are laying off. Indian IT companies are still hiring, but Indian IT stocks are down. Foreign institutional investors are not sellers in the month of March. That's what data is telling us. They've been net buyers. So FIs are buying, DIs are buying. And the problem is global in nature, but Indian markets is underperforming. So this is quite ironical if I really look at the market right now. I smack of low participation, low volumes and some compulsions, maybe at PMS, HNI interest is waning down, volumes are waning away. All that is really having an impact per se on the market. But today for a change, Nuresh, we are holding above 17,000. The ring of this number, Nuresh, 17,000 ke upar hai, is a good ring to have.
Yeah, so at least we are above 17,000 is the way to look at it. But if we look at the bank Nifty, it is sustaining well above the 39,500 mark. And what we are seeing is global indices also have recovered quite a bit, almost 3 to 4%, 5% from the lows. So today we have expiry pressure that could continue, but hopefully all this augurs well for a better April month and the whole year going forward.
What's your take? Where is the expiry going to be? Because over the last couple of trading sessions, we have seen that last 30-minute, 45-minute move come by today. Do you expect the rally to sustain?
Yeah, is it for me?
Yes, Vinay, for you.
Yeah. So I am expecting that Nifty should close between 16,950 to 17,000 mark, and we see a strong support around 16,900. And Nifty has been consolidating for last 4 consecutive sessions, and it is into a range of 17,100 on the upside and 16,900 on the downside. So we have seen some profit booking in last 15 minutes. Again, it is going down. So overall trend is still down unless and until Nifty closes above 17,200. We are cautious. But no doubt today breadth is going very positive, and that is a good sign, and global market support is also there. So some sort of confidence is coming in stock specific bullish trades. So yes, we see some strength in the stocks and breadth of the market, and unless 16,900 is breached, one should remain optimistic and one should take stock specific long trades. So there are many stocks and sectors which are outperforming, so we should concentrate stock specific right now.
Anshul Saigal, good afternoon. So good to have you back. You're not smiling or you're not looking happy today. It's okay, sir.
Good afternoon.
It's okay. Markets will recover one day.
Meeting you, I'm always happy. I may not smile, but markets will. I have the least doubt markets will rebound. It's only a question of time. Last 2 years, nearly 19 months actually, since October 2021, we have seen the markets go down one way. You have seen the small cap index correct by as much as 15%. Mid caps are about flat, large caps are flat. But then if you look at the constituents, there are many stocks which are down 30-50% in this period. Now, I mean, if there is a sale in a shirt shop, people run and go and buy shirts. But if there is a sale in the markets, the fear is that this sale will become dearer. And so they will stay back till there is further correction in prices. And, markets will never tell you that this is the bottom. So clearly, when markets give you this opportunity, one should build portfolios. We believe that this is such a time where one should be building portfolios for the next year and the year after that.
Okay. Anshul, the problem is with US banks. The problem is with US big tech. S&P in the month of March, which was supposed to be a tumultuous week because of US banking issues, CSFB and UBS, S&P and European markets are up, Indian markets are down. So the problem is in the world and we are falling. How ironical is that? I thought India was supposed to be the bright spot.
And Nikunj, that's right. Although if you look at last year per se, there was material outperformance that India saw. Some of that outperformance is being given away in recent months. And it is good only for the health of the market that this differential in valuation, where India had become far more expensive in terms of valuations versus other markets, that differential has come off. That gives us comfort that the times ahead will be better for India as compared to the recent past. Also, I mean, some quality names are, I mean, I can tell you, Nikund, that I'm spoiled for choice. Quality names have corrected meaningfully where growth perception, growth expectation hasn't waned. And earnings visibility is definitely there. In such names, valuations have corrected, which gives us opportunity. And so, in fact, this uncertainty should be, should make people happy rather than anxious, because in this uncertainty, prices are becoming favorable. This is not risk, this is uncertainty. And that differentiation should be made.
Example, what is risk, what is uncertainty? If you buy uncertainty, you always get bargains. What are you buying? Where are you buying uncertainty?
We are not restricting ourselves to one sector or the other, but I should tell you that in terms of earnings visibility, we are seeing that play out in the financial space, in capital goods. We believe that in select autos, we are finding opportunities. We are also finding opportunity in defense. Some of the defense names which had become overly expensive are now at relatively reasonable valuations. So across the board, even IT for that matter, the mid and small cap space in IT, that's corrected like like there's no tomorrow, and that's giving us opportunities. So across the board, on a stock specific basis, we are finding opportunity. And just I'll take 10 seconds more. The kind of framework that we follow and which has helped us over the years is that in times of uncertainty, don't worry about the frequency, worry about the magnitude, which means that in near term, you'll see the prices stay in a range, go down a little bit. But if the magnitude of the upside is substantial over a 2-3 year period, then focus on that. And rarely, if ever, you'll go wrong in such a framework.
Okay, let's see. So there are a lot of opportunities, and Anshul definitely spoiled for choices. But today there are a lot of stocks which are buzzing around on news flow as well. Let's take a look at Adani Group of companies because they seem to have recovered substantially. So whether it's Adani Enterprises, Adani Ports, or a couple of other names as well from the Adani Group, they are doing well. And that's because the company has issued a clarification that they have repaid some of the debt as well as the pledge holding has been brought down. So some of these counters are on our radar. Z Entertainment too was up around 4%. Remember, this is something that we already expected, but now there is an official statement coming in from Z that they've entered into a settlement with IndusInd Bank. They are looking at settling all the disputes and claim. They haven't paid any penalty and they are expecting no material impact as far as the P&L is concerned of the company at this point of time. So 3.5% gain coming in there. IRB Infrastructure is up 6%. There's an 18% hike which has happened in the Mumbai-Pune Expressway tollway from April 1st, and perhaps the street is building that into the numbers as well. So IRB Infrastructure up around 5.5%. Nuresh, wanted your take regarding a couple of these counters, whether the Adani Group, Z, IRB, are you looking at anything which becomes a good, interesting buying opportunity?
So would be waiting out for a little more price action to confirm that. So Z has come up on the radar. The stock is back above that 215 mark. But if it can sustain above the 220-25 mark, which was the last time where it topped out at and saw a big correction, then it would be a longer term trend change. So the stock is on radar because purely the bounce back has been sharp. IRB Infra is something which not really interested in. The stock saw pull up on the bonus split. But the sector looks interesting. There is a Ahluwalia projects which looks interesting in the sector. There is a NCC which looks interesting in the sector.
Names which are actually buzzing from this infrastructure quasi-realty space is Macrotech Developers, which is good at 9% up today, and NBCC2 is up around 7.5%. Vinay, a word on these two names?
Yeah, so Lodha, the Macrotech developers have seen a healthy correction. We saw that on 3rd of March, the high was 1087 and yesterday's low was 7777. So healthy correction we have seen, and now today it has gone up 9% with a rising volume. So definitely there is a chance because infrastructure and real estate stocks have been witnessing some short covering, and I think it could continue. Stock specific market it looks good, and not for the positional basis, but at least for 2-3 days, we can expect some extension of the pullback in a stock like Lodha Developers. So it is currently quoting at 855, and we can expect it to move towards the next resistance of 925, which is immediate target I can see. So 925 is the next resistance. Volatility is very high, so that's why I'm giving the level which is far from here. And the support should also be kept at around 850 or not 810 should be the stop loss in the Lodha Developer. So yes, pattern is good and chances of extension in pullback is higher in Lodha Developers.
The breadth is looking good for a change. It's really looking good for a change. Now, what's standing out? Just look at Paytm. From the recent low, up more than 30%. The recent low was below 500. Today, it may be having a day out, but otherwise, Paytm from the recent low has done well. From the all-time high, you got to be kidding me if I say that it's anywhere close to its all-time high. But when large anchor investors actually exited Paytm, 450, 460, 500, the stock actually bottomed out. Flip it around with Zomato, 150, 160 I think was an all-time high. It's languishing at 50, but this is one stock which in last 52 weeks has given no change. Nykaa on the other hand got completely smashed. This was one company which had a promise of cash free flow. It was generating free cash flows, but if you adjust the bonus part as well, the stock has just got knocked out. But Policy Bazaar is the one which, frankly, if you ask me, is the one which has done rather well from its recent low. They're talking about profit, they're talking about growth, they're talking about 1,000 crore of PAT by 2027. So this is one stock which in a sense is completely, it has come up like a phoenix, so to speak, from the ashes. Very strong movement in policy fintech, 52-week change just down 15%. Anshul, where are you shopping in this space? I mean, are you shopping at all, and if yes, where?
We have, Nikunj, stayed away from this space all through this time. And there is a reason for that, which is that we are cash flow buyers. We are not buying in the hope that someone will buy from us at a higher price tomorrow. In this space, that excitement was more as compared to the cash flows that these companies were generating. For that reason, we stayed away. Even today, if you ask me, this is a space which is a play on liquidity easing globally. Only then will this space get some succor, some support at the bottom. And so even for now, we will stay away. At some point in the future, maybe when we get a better hang of what's happening at the macro level, we will look at this space. But for now, we are on the sidelines.
Sidelines still when it comes to some of these new age tech companies. Taking a short break with the news that markets have ebbed a tad bit. 17,000 is where we are at. Suzlon Energy, Praj Industries, Garden Reach, Raymond. These are the counters which have suddenly spiked and are all up anywhere between 6 to 10%. And even Home First Finance is suddenly showing quite a bit of price volume action. We'll do one thing. We'll slip into a very short break, but don't go anywhere. There's lots to track when we come back. Okay, so the market is holding up well above 17,000, so that's the good news. But remember, it's going to be fourth consecutive month of negative expiry after 2 decades. What does it mean for traders, and what should we expect in April series? My colleague Sharad has done some analysis. He's joining us with more on that. Hi, Sharad.
Well, yes, a very eventful series in the month of March. We are seeing Nifty itself give a downturn returns of almost 3%, while for Nifty Bank itself, it has been largely flat but trending with a negative bias. Now, looking at this, this will be the fourth back-to-back month where the expiry will be coming in the negative. This applies for the Nifty cash market, and if the levels of 16,800 comes down, then the next major support would be 15,500. But what makes this expiry very interesting is an anomaly has happened, and this has happened first time in at least the last 2 decades. This is the first time for the 4th straight month we'll be actually seeing Nifty coming in the negative returns, and this is actually for the cash market. We did have a poll as well, and over here majority of the traders, they are actually stating that the Nifty range is expected to come between 17,000 to 17,200, while for the Nifty Bank itself, they are bullish between the ranges between 39,500 to 39,800. But apart from this, what the rollover data is suggesting, of course, Nifty is having a 61% rollover, while for Nifty Bank, it's on the higher side at 74%. Looking at the sectors where there's a positive rollover, it includes cement, FMCG, and the pharma pack, while on the negative side, we have IT, metal, energy, and the banking stocks. Apart from this, also, let's looking at the stocks, the highest rollover comes in for Berger Paints, Chola Finance, Jubilant Foodworks, and Shree Cement, while on the lower rollover side, we have companies such as Oberoi, Realty, Atul, GMR Infra, and Madas and Sumi.
Session with Vash Srivastav, we got Anshul and our good old Nuresh Mirani. But I'm going to go back to the market mood right now, and the market incrementally seems to be moving higher in terms of the trajectory, what it seems to be following. Anshul, what is the update with the PMS schemes in terms of the inflows and outflows? I mean, they suddenly are being called as the stepmotherly, they are called as the folks who are giving this market a stepmotherly treatment, because mutual funds are saying we are buying every day. You can look at the figure. FIs are saying that we've stopped selling. It is the PMS guys who are selling every day. Is it true?
What happens, Nikunj, in the PMS space is that you're well aware that this is a managed account structure. So each client sees not only the NAV, but also stocks that the client is holding. And for that reason, the involvement is much greater and on a much day-to-day basis in the PMS business. And in times like this, when you have had a large bout of volatility, and many of the stocks which were trading at 30-40% higher than current prices, those have come off a little bit over the last, say, 15 to 18 months. These clients get a little nervous, and as a result, one sees that nervousness reflects in flows. And this is the nature of this business. You will see that when the markets are doing well, these PMSs will again start buying because flows are great and they will push the markets up. And when markets are kind of iffy as they are today, because of this tendency of the investor, PMSs will also sell. Having said that, I must say that at this time in the market, if you look at the DII cash data, they are sitting at nearly, I think, a decadal high, if not more, at 6% cash on aggregate. In addition, if you look at FII short positions in the market, those are also at a significant high, even higher than June of last year, where shorts had peaked. Now, this is a setup which tells you that this is probably an oversold market. Of course, the joker in the pack is the macro globally, where you don't know how the banking system globally is going to move. There is some amount of assuaging of fears by backstopping by the Fed. But if there is a credit event globally, then of course one could see downsides. Other than that, much of the downsides are already in the price as positions, both at the FII end as also the DII end shows.
The technical view as well. Rohit, hi, thank you so much for joining us. You have turned constructive on the market, but still it continues to be very, very sideways, and we are perhaps staring at a fourth month of consecutive decline. What do you think April will hold for us?
I think this should be the last and final month of negativity, and you were making that analogy some time back about 4-month declines. I think that's a very important one. You actually can go all the way back if you want really 4 consecutive. You have to go all the way back to 2001. The 9/11 crash was preceded by a 4-month decline. In fact, that was the 4th month, and what it was followed by is a multi-month advance. So the history of 4-month declines is pretty big. I think if you want a even larger time horizon, you'll have to go all the way back to the Pokhran bomb case, where in 1997-98 you had a almost 5-month decline from June into November, December. So those have all been reversed pretty meaningfully each time. In fact, that one was reversed with a continuation of the Y2K bull market. And so I think you're coming to the end of this. Not only that, I think seasonally, the March month has been an interesting one because markets, declined for the last few months into the month of March. We've often seen meaningful bottoms in the month of March, including March 2020, You can go all the way back to March 2009. They were all significant lows that were made in the market. So, and time-wise, from the high that we made in October 2021, we are 18 months into this bear market. Although it's not been downwards, it has been, in terms of index, it's been sideways, but a lot of stocks have seen significant retracements and declines also in this phase, which I think even time-wise should be coming to an end. So my sense is that this is the last month. You're going to kick off into a multi-month, advance from here. The rest of 2023 should be mostly bullish. That's a pretty strong view that I'm taking.
Questions there, Rohit. If we are going to be in multi-month uptrend, where do you see the year end likely to be? And secondly, which are the sectors or segments do you think which will drive the growth? Is it going to be banking, autos, any other beaten down sector that you are watching out for?
So we stick with the strength. I mean, we've seen strength in places like defense. We know that capital goods, for example, as a sector, is getting a lot of government support, and that should do well. These are actually the outperforming sectors.
Come back to you. I think we are getting some echoes and technical glitch as well. But in the meantime, for the market, 17,016 is where we are holding at. But Anshul, your take as far as the auto stocks are concerned, and this is a question we have been discussing and debating as well. Which are the stocks do you think which will outperform this year from the auto space? M&M, Tata Motors, Maruti, which is the one that you think will be the strongest leader of sorts?
We would focus on passenger vehicles and commercial vehicles. We think that in commercial vehicles, particularly, the cycle is absolutely robust. And this is typically a 3 to 4 year cycle, which started sometime in 22. So could go on till 25, 26. And as a result, when you see volumes pick up, you will see margins also expand. What we saw as a result of COVID is that smaller trucks, smaller commercial vehicles were getting sold. Buses, volumes of those came down, and heavy commercial vehicles, those also came down in volumes. Now, if this cycle progresses as we anticipate it will, then these segments will start doing well. And those are margin accretive because those are, higher ASP products, average selling price products. So our assessment is that the cycle is strong, so volumes should do well. And within that, the mix should change favorably in this space, which should aid margins. And the street is not expecting that because that doesn't reflect in multiples. So this is a space that we like in the autos category as a whole.
Okay, I think we have patched that line with Rohit as well. Rohit, just quickly wanted your take with respect to the sectors you were saying is likely to outperform. So apart from defense, you said, which are the other ones?
Yeah, so capital goods, which has been, supported with government measures, I think that's one in terms of, even the capital goods index has been one of the outperforming sectors of this time period. So I think you stick with that. I would also, in the beaten down names, look at metals because I think metals is in a long-term upward cycle. We have seen a significant pullback in the metal stocks. But going ahead, I think they should pick up as well because if you simply look at metal prices globally, copper prices have significantly moved back high. Almost 60-80% of the losses they've made have been recovered. And that I think is a signal. In fact, one of the key drivers for commodity prices is the dollar itself, and the dollar index peaked in September of last year. So I think the commodity cycle is slowly coming back. The last part of the commodity cycle was oil prices, which did fall back to around $64 on WTI. And I think that should also have bottomed out. So broadly speaking, I think the commodity related stocks should join the up move, and that's where I would look for bottom fishing.
Very philosophical question here, and just Anisha and me were talking about it when we were preparing for the show. What we've done is that we've taken the clock back. Pardon me if I'm being selective here, but we've gone back to January 2020, when the world did not have a COVID problem, right? And today COVID technically is over. And you look at what the market return are from 1st of Jan 2020, the market has given a CAGR return of 12%. Now my point is, Anshul, we've digested a extraordinary volatility, a bout of COVID, extraordinary low interest rates, extraordinary spike in inflation, but ultimately, despite this 3-year mega up and down, peak and tough kind of a cycle, equity market have only given you returns which are in term with long-term averages.
I couldn't agree with you more, Nikunj, and this goes back to the point that I was making earlier regarding differentiation between risk and uncertainty. Now, if you look at the period of COVID, you saw global plays, even Indian plays, which were going to survive in that environment, do very well in terms of their stock prices. Companies like companies in the space of restaurants, movie theaters, travel and tourism, those were in the dumps. Now, the expectation was that this is not uncertainty, this is risk, the world is coming to an end. But if the belief of an investor was that this is a time where, of course, there is uncertainty because of what's happening around us, but this is temporary, and that this too shall pass. It is a dot in the larger picture that the world, in the continuum of the world. Then these businesses where one wants to travel as a human being, one wants to travel, one wants to mingle with other people, wants to go to movies, all of those will come back. Then one could have played that uncertainty and made the distinction between risk and uncertainty. Markets over the long term are driven by human, sort of expectation, hope of growth, etc. And if one has belief in that, then, and one is optimistic by nature, then there is no better asset class to be invested in for the long term than equities. So and whenever we speak with clients, we always tell them that we are believers, and we are steadfast believers that this is the asset class to back and invest in for the long term.
We'll slip into a very short break at the moment with the news that the market is very close to the highest point of the trading session. We have a 110-point uptick on the Nifty. On that note, we'll thank Rohit as well. Thank you so much for making time and speaking with us on the day of the monthly options expiry. And for now, the picture seems to be pretty. And the 3 p.m. move which we're witnessing at this point is at least on the upside. So there is no sell-off which is happening. In fact, a big spike as far as Nifty is concerned. Let's quickly pull up the Nifty Bank as well before we slip into that short break. Is the move coming in from Nifty Bank? Yes, that too is high by around 300 points. Taking that short break and we'll be right back.